All right, I think we got it covered. Well, good morning. Thanks for joining us. Welcome to Fiducient's speaker series for May 1st. I'm Brad Long, Managing Partner and Chief Investment Officer here at Fiducient Advisors. In just a minute, I'll introduce our guest for the day, but to give you the admin. So we've got 30 minutes stacked up for you. We'll probably move quickly. We want to pack a lot into the next 30 minutes. So there will be a recording made available after if you missed something. Also, please feel free to ask questions along the way. You can put those in the chat queue. What we'll try to do is we'll try to get to your questions throughout, or I'll queue Andrew up for some of the questions in case a lot are coming in, and we'll also reserve a little bit of time in the back end for any questions that might be lingering. Finally, if we don't get to your questions and we're overwhelmed with questions, you can always feel free to reach out to your consultant. We're happy to get myself or Andrew on the line to address those following questions. So with that said, why don't we jump in here? So today we have Andrew Furney joining us from our Marketable Alternatives team. I'll interchangeably use Marketable Alternatives and hedge funds. That is our kind of glib word or marketing word for hedge funds. Andrew's background here, he's been with the firm for about a half a dozen years, as you can read in his bio and see on our website. He has 2 degrees from Washington State University. He's a CFA and CAIA charter holder. But a couple of things you might not know about Andrew. So first, he was a kicker in the NFL. He was a kicker for the New York Jets. So if you're a Jets fan, hooray. If you're not, don't hold it against him. The second thing is he's actually completed the Ironman. If you're not familiar with that, it's a triathlon in which really only in kind of somewhat insane people approach. It's a 2.4-mile swim, a 112-mile bike, and then a 26.2, aka a marathon run after. So it's hard to say, with a straight face that anyone will outwork or outrun Andrew when it comes to knowledge of covering his space. So Andrew, we really appreciate you spending a little time with us this morning.
Geez, thanks, Brad. Really appreciate you having me on today, and wow, appreciate the nice intro there.
No problem. So with that in mind, what we're going to dig into is we're going to dig into hedge funds today, or marketable alternatives. For many investors, it ends up being a space that has somewhat of a mystery around it, right? There's a lot of opacity. There's not a lot of transparency. And so, what we want to do is kind of pull back the curtain, give you a little bit of the trends, things that are going on, what's driving hedge funds returns, and give you kind of the insider's look into that market today. So, Andrew, with that idea in mind, and that most investors kind of start with what they know about hedge funds is what they read in the Wall Street Journal. Like, why don't we start with the 101 on just what's been going on from recent returns, call it Q1 of this year, last year, and key themes that are really driving those markets.
Yeah, and I think if you look at the broader hedge fund universe, and just to peel back the curtain a little bit for you there too, right? From a broad perspective, hedge funds is a really broad investment strategy. Hedge funds can really invest in essentially anything, whether that's fixed income assets, equity assets, the use of kind of complex derivatives. It's really a full spectrum of really what encompasses the hedge fund universe. And that being said, you've got a variety of different flavors of different strategies. And as you can imagine, given different market environments and different opportunity sets, you see kind of a wide spectrum of performance as kind of different strategies come in and out of favor. And I think last year and even the start of Q1 is a great example of how those different strategies have performed in different market environments. Just looking at kind of last year, for example, as we all know, kind of markets really driven by the Mag 7 and a very kind of concentrated cohort of names kind of driving broader markets. And as you can imagine, strategies that have typically more equity-like exposure, so think equity hedge strategies, which is really long-short strategies within equities, and event-driven strategies that, again, typically have a higher amount of equity exposure, fared a little bit better, as you can imagine. Where I think some of those other strategies, think relative value type strategies, that are really dependent on dispersion between winners and losers, and having a wide variety of stocks to kind of manage a portfolio against. And even in credit securities as well, were a little bit more muted, just given the natural backdrop of kind of drivers in the marketplace. And then if you kind of look at from a global perspective, I think you had a little bit more of a muted year as well when it comes to the global macro type environment last year, with a little bit some more uncertainty around when the rate cuts would end, what those would look like, and things like that. Where I think coming into the start of this year, macro is kind of back on their front foot and performing really, really well. So kind of the tale of a few different years and a few different market environments already over just a short period, kind of highlighting some of the backdrops and different drivers within a variety of different strategies that we all call hedge funds broadly.
Yeah, it's kind of like if you've met 10 hedge funds, you've met 10 different, very different risk and return profiles.
Absolutely.
And the last couple of years, it has felt like dog years, right? In which every year feels like it's multiple years packed into one. But why don't we jump from just last quarter, last year, into unpacking that idea of the diversity of hedge funds, and frankly, some of the first principles that your team, works on really the need or necessity to diversify a portfolio. As you mentioned, it is kind of a random walk, even in some of these categories. Hedge funds as much as a legal structure as it is an investment asset class. So talk a little bit about diversification and frankly why it's so critical, even here more than other spots.
Yeah, absolutely. And I think if you kind of double back and you take a step back of just the last few years, I think everyone on this call would agree that we've all aged certainly far more in the last few years and what markets have thrown at us. And I think that natural environment and that reality of what we've experienced highlights exactly what you've mentioned there, Brad, which is diversification within an all-weather portfolio is critical. Just looking at a couple examples here, you look at, call it an undiversified portfolio, maybe that's highly concentrated, maybe only a couple line items, a couple managers, a couple strategies, where you're really picking your spots to hopefully outperform, has really resulted in a bumpy, hard to digest ride. So for example, if you're someone that had, a highly concentrated portfolio and one of those managers was kind of a levered, high octane tech hedge fund, right? You've had some good success in previous years, but you look back at years like 2022 and you saw a down 50% potentially within your hedge fund portfolio. So certainly very, very difficult to kind of stomach some of those outcomes in a more concentrated portfolio. And I think if you take a step back and you're looking at what the objectives of a hedge fund portfolio really are and what they should be and how we kind of think about hedge fund outcomes within a broader portfolio context, is really providing two things. The first thing is really being a diversifier within your portfolio. And that really means an uncorrelated, differentiated return stream from other holdings within your broader portfolio. So think your equity allocations, your fixed income allocations, your real assets. So really being a diversifier and being uncorrelated to those holdings already in your portfolio is a key element. And I think the second thing is a little bit what I touched on with the kind of the example is being a ballast in your portfolio to really manage the downside and protect capital well, particularly in times of market stress. So collectively as a team and as a firm, we really think of that as the key objectives. And the best way to achieve that outcome is true diversification. And that's diversification across both strategy types, as we talked about. We're going to have different environments where those strategies are going to be in and out of favor. So diversification across the strategies, different managers, you kind of eliminate some of the operational risks and single firm risks that are involved with investing in a manager. And lastly, just geographies as well. Just being diversified around the globe really allows you to take advantage of geographies that are come in and out of favor as well.
Fair enough. So as we think kind of moving on from first principles, right, and kind of stepping into today's environment, one of the key trends that's been out there is this idea of platforms. And I know you call it, kind of the elephant in the room. I've referred to it as kind of platforms eating the world. But for those that are unfamiliar, platforms in hedge fund parlance is the Citadels, Balyasny, Millenniums of the world, where it is a kind of a large hedge fund with multiple risk takers underneath that all aggregates into one underlying strategy. And I guess maybe not disproportionately in the media, but they probably garner most of the attention, and maybe rightfully so. And I know that's a key trend that's driving the space. And so, how have you all been thinking about that? Because I know it's an important component of how we want to allocate capital and potentially risks out there.
Yeah, no, it's a solid point. And candidly, you can't really have a view, you can't really operate within the hedge fund universe without being aware of these big players and these big platforms within the hedge fund space for a few reasons. First and foremost is their size and how big of a footprint they have. A really interesting data point that we called out in a previous piece, I think it was from a Goldman Sachs kind of snapshot of the hedge fund universe, was over the previous 5 years, multi-manager platforms, AUMs, have grown by 150%. On a relative basis, the rest of the industry has only grown by 13. So not only are these platforms, being sponges and absorbing lots of capital and increasing that footprint, but there's also a lot of interest from just allocators, generally speaking, to the model, just given the underlying diversification that comes with allocating. That being said, you kind of step back and you look at that increased footprint in the market and the ripple effects that come with that. First and foremost, it's really difficult to have conversations with any hedge fund manager without kind of bringing up the aspect of these large elephants in the room, like you alluded to, and their market impacts. And so really from just a risk management perspective, for example, you're another hedge fund not working at one of these firms, you kind of have to be aware of how those firms are investing and what they own and what they're exposed to, because there could be ripple effects throughout the market. If they have to liquidate, they have to get out of a security, they have to move quickly. So there is going to be price impacts. And then also,
so Andrew, on that, meeting specifically like crowding and concentration, right? So the platform's
right,
just a lot of money. If they're, chasing kind of a fewer trades or have a pair trade on something like that, that if they end up moving, the market can move with it.
exactly. And inherently, these platforms are very Darwinian in nature. They have very, very tight risk limits. So just to give you an example, a really good trader that's running a very, very big portfolio within these bigger firms maybe hits a risk limit and gets terminated. That firm has to essentially close that portfolio, sell all the securities. So there's this kind of ripple effect that could happen throughout the rest of the market, and just having a pulse on what's going on could be, something that's notable and drive outcomes within the market, specifically in hedge funds. And I think a second aspect of just the growth of the platforms and the multi-manager platforms throughout the industry is it's really had an impact on new launches really in the space as well. So you think about a great investment manager, a great portfolio manager, really having two, decisions to make. One being, do I go venture out on my own and start my own firm, or do I simply go to one of these big firms that can just give me capital to trade, and all I have to worry about is running my investment strategy, running my portfolio, and I don't have to really worry about the complexities of running a business. So it's introduced a lot of alternatives to really good investment managers just staying within one of those platforms as opposed to going out. And you've seen certainly an impact on the new launches within hedge funds, and certainly fewer names and fewer managers kind of deciding to venture out on their own and take that business risk.
Yeah, fair enough. So, as we think about, some of those kind of platform impacts, and zoom out from just the platforms into broader market impacts, one of the things it's been on every investor's mind, right, is Fed policy, rising rates, potentially cutting rates at this point. When is the Fed going to be reacting? We've talked, if you think about our 100% of our portfolio, we talked extensively about the impact of rates and fixed income. I think most and many can connect the dots between what that means for equity. On one of our last call on alternatives, we talked with Michael Sostarczyk and Angelique Pappas on the impact of higher interest rates and the flow through effect on private equity, acutely venture and growth equity. But obviously, nothing is immune from a higher cost of capital, higher interest rates. So talk to us specifically about what is the environment. It's a new environment relative to the ZIRP world, the zero interest rate policy world. What does that actually mean for hedge funds? Is it good, bad, and different? Like, what are the pros and cons there?
Yeah, I would say first and foremost, similar to all the things you echoed with other asset classes, that also remains true here. Really higher cost of capital, hopefully a broader opportunity set for an active manager to really add value and identifying both winners and losers. I think where hedge funds are uniquely positioned, though, in that backdrop is given their ability to short and express and generate return on shorting a security, they can essentially express and generate return from picking those losers and identifying them, as opposed to just
And just to make sure everybody's following, because right, some people don't wake up in the morning thinking about hedge funds. Shorting is what? Making money off of the falling of price in a security,
right.
right? Most of the time when we're long a stock or a security, we make money as the price goes up. Shorting is the opportunity to make money as the price goes down, right?
Exactly. Yeah, well put. And exactly like that is to your point, as those winners and losers come out of the woodwork, so to speak, and are exposed kind of with this higher cost of capital, hedge funds are really uniquely positioned to benefit from both picking the winners and benefiting as those prices rise, and then picking those losers and benefiting candidly as those prices decline. And they identify those struggling companies or capital structures, for example. But I think more importantly, I think one of the most unique aspects of hedge funds and some of the tailwinds that it actually generates for hedge funds in particular is what we consider kind of the short rebate. So you can really think of, again, kind of piggybacking on the description of shorting, taking one step further without trying to get too technical here is when a hedge fund shorts a security, they essentially have to borrow it from someone that holds that security. And as a result, there's a cost associated with that. So you pay, call it a small nominal fee, 50 to 75 basis points, but you also have to pay, call it the dividends or the coupon payments that typical person holding the security would have. So call that an all-in cost or expense to actually borrowing a security. But when the hedge fund receives that security and they short it, what they really do is immediately sell it. And in return, you sit on cash. You receive that cash proceed as if you sold a true security. So as you can imagine, as the return on cash has substantially risen with alongside the rate hikes, you've seen a nice tailwind to hedge fund strategies where historically it's been, call it a negative carry, or you're really paying out a small, call it coupon to really short a stock. In return, you're actually now receiving a positive coupon just to being short. So it gives you a nice, call it tailwind, particularly on half of your portfolio. So as we can see, and I think where this is particularly important is you look back historically, where you look at this equation of the cost to borrow and the return you're getting on cash has been negative in that zero bound interest rate environment for almost a decade. And as you think about shorting, as markets kind of tend to go up over time, that's already a very difficult task to do without creating substantial drag. So the fact that you can get positive kind of return from shorting and being able to hedge risk is a really nice tailwind, not only to just absolute return portfolios, but just generally speaking, should help elevate returns within hedge funds, broadly speaking.
So kind of in summary, it seems like two major themes coming out of, higher interest rates environment is use the Warren Buffett analogy of kind of, as the tide goes out, you can see who's wearing swim trunks, right? So in a world in which higher interest rates may create more volatility in stocks, you can take advantage of that from profiting on their demise or falling in price. And then the second is this more technical factor of rather than being a headwind, in shorting, it can actually be a tailwind in shorting and provides a little bit of extra cushion. Is that fair?
Exactly. Yeah, well said.
Shifting from just interest rates, because I know interest rate policy here, as investors, most of us sitting here in the United States, it's really a Jerome Powell US interest rate centric conversation. But we know the world is filled with debt beyond just the borders from California to New York. And one of the areas that you all have been spending a lot of time on and, recently came back from, a trip to Europe is European credit, right? So we're always looking and trying to find opportunities for new ways to add value in portfolios. And this was one of the areas that your team had identified and started to dig in on. So why don't you give us a little bit of color of like, what is it that's attracting you all to that market, some of the work that you did and the primary insights you guys gained from that trip and spending a lot of time analyzing the space?
Yeah, happy to. And I think a good place to start there is really just understanding the characteristics that make European credit markets particularly unique, and what makes them different relative really to the US, which probably a lot more people are familiar with. And a couple of things kind of stand out there. I think the first thing is even within kind of the European Union and call it Western developed Europe, and that's where we are particularly talking about today. You really have a variety of cultures and languages. And more importantly, when it comes to kind of investing in credit, you have a variety of legal frameworks. And so when you talk about kind of creditor rights, both legally and figuratively within the region, there's a very wide dispersion between creditor rights. So what practically that means is having kind of boots on the ground, intimate knowledge, not only of how to navigate the cultures and the languages and being able to talk to those local companies in their own dialects, but really understanding the complexities of the court system, particularly when you're investing in credit, is really, really important and is something that's quite unique to Europe specifically. So a great example is you take, for example, France, which everyone would consider very Western, very developed. You look at that country and their legal framework is very unique when it comes to credit. It's very company and shareholder friendly. So as a creditor, and you get into maybe a particularly hairy situation, you don't have as much rights within that legal framework. So being able to have that knowledge of the legal system and how to navigate it and know where the potholes are and to avoid those is really, really unique and critical within kind of a very diverse, unique region of the world, specifically speaking to credit.
I couldn't imagine the exponential amount of complexity here in the United States if we were buying a bond in California or Ohio or Florida and having to navigate, 50 different legal systems and languages and cultures. And, it creates a lot of space for confusion and opportunity. So there's kind of you can naturally see the attraction there.
Yeah, exactly. And just to kind of to piggyback on that, there's a few other things that I think are really interesting and unique about the European kind of credit space in particular. I think another one being that Europe is really sprinkled with, call it, smaller family-owned enterprises where their bonds are actually publicly traded. And as a result, you see a lot smaller issuance and capital structures. So typically, having a manager profile, for example, that's smaller in size, smaller AUM levels that can navigate and be meaningful within some of those smaller capital structures and invest in those is another kind of interesting element that's unique, I call it, to European markets specifically.
Andrew, you mentioned size, right? There's some smaller opportunities there, but what about the size of that market in general, right? Is it double the size of the US? Is it half the size of the US? Give us some color on like what European credit looks like.
Yeah, broadly speaking, across the entire spectrum, both call it investment grade and high yield, is about the third of the size. So you're talking about, call it an investment grade, about 8 trillion in investment grade across the US. You're talking about a third of that within Europe, developed Europe specifically. And similar things apply over to the European high yield market, specifically where hedge funds tend to play. In the US, for example, the high yield market values roughly, call it 1.5 trillion. And across Europe, again, developed Western kind of Europe, what we're talking about here is only about 400 billion. So certainly a much smaller footprint. As you can see, kind of relative in these charts compared to the US, you have seen some nice growth in those capital markets and those credit markets in particular, but certainly been not as rapid as what you've seen within the US, for sure. And I think to complement that, right, is you look at, call it the credit quality. I think when you think of international markets outside of the US, you think inherently more risk. And I think if you peel back the onion and you take a deep dive within the high yield market in particular, you've actually seen the opposite is true. Within the European high yield market in particular, you've actually seen a skew and a bias towards uh, higher quality double B names relative to the US. So you've actually seen kind of a quality or higher credit bias across. And I think on this chart on the left here is really important to notice. This isn't a new trend or an anomaly. This is something that's been true historically and is commonly overlooked over. So there's certainly a nice backdrop when it comes to kind of beating down the stereotype of international means inherently more risk within markets.
So, many investors still have kind of mentally anchored to, a time of negative interest rates. Europe was leading the edge on that, where they've had, negative mortgage, negative interest rates. Tell us a little bit about just kind of basically spread or yield that's available in that market. Is it comparable, superior, inferior to the US? Like what does that opportunity set look like?
Yeah, so there's been naturally a little bit higher spread. Again, I think there's this assumption that internationally there's certainly far more risk associated with it, and as a result, there's typically been for equally rated securities across U.S. versus Europe. I think you've seen a nice premium where European investors, in particular, can get a nice additional return for taking similar level of risk. And I think that's really an important and interesting opportunity set for managers playing in that space in particular. You know, if you're looking for adding a manager specifically in Europe, I think this is a really compelling backdrop to add value and diversify in a broader portfolio.
So we have a couple of minutes here and still trying to roll through questions and make sure we get to all of them. So, okay, compelling opportunity set, a lot of opportunity to add value. What characteristics are you looking for in a manager to partner with in that space that you think they have a higher probability of success given that backdrop?
Yeah, I think there's a few things that we look for. First and foremost, we look for, really key competitive advantages. And really what we're looking for there is something that's tangible and identifiable of really making that manager unique and differentiated not only from broader active managers, but peers within the hedge fund space. So some quantifiable edge or advantage. So it might be data, that might be pedigree, maybe where they were trained, or really there's their ability to manage risk, which is a very unique skill, particularly when it comes to the hedge fund space. And I think the second really important aspect, what we're looking for is truly diversification, a truly skilled manager that does not rely on the direction of markets to really drive outcomes within their portfolio, which is a very, very difficult thing to do consistently over time. So collectively, we think those two really big, broader, high-level elements are really, really important for kind of a successful hedge fund manager, broadly speaking.
Makes good sense. So in kind of an elevator summary, and you can keep me honest here, kind of thinking back through your comments, hedge funds, kind of first principles diversification is key. It's as much of a legal structure as an asset class. You're going to find a lot of weird stuff in there. So you got to really know what you own and diversify it thoughtfully. Higher interest rates, there's all sorts of nuances there, but the ability to short, can create benefit in a higher interest rate world, and some of the technicals on the short side of actually getting paid rather than, having a headwind, you've got a bit of a tailwind. And then, European credit, with all the points you made on very diverse, complex background, creating an attractive environment for a thoughtful investor to add value. And to your final points on the type of strategies that we would go for. Anything else you'd add on that in our last kind of 30 seconds here?
No, I think you did a great job summarizing it, and I think there's a really interesting backdrop for hedge funds, just given all the things you talked about. So really interesting to see going forward how things shake out.
All right. Well, appreciate it, Andrew. And again, thanks to everyone for calling in. If we weren't able to get to your question, feel free to reach out. We're happy to address it individually. We appreciate you coming in, and then check out Andrew's paper that gets into greater detail on this. You can find it on our websites in the insights section. But again, thanks, Andrew. We appreciate your insights and thoughtfulness.
No, thanks, Brad. Thanks for having me.
All right.